Are you in a
Yeah.
baking class?
There's, this is like the discussion we're having. Which one would you rather? The schemaless like US or Australia?
Yeah.
I'm sure they do.
If they were
Not like
here,
delicious.
it's better.
It's good.
We're having our meeting tomorrow.
Which is
Yeah. Molten chocolate.
Yeah, this is
so
I tested.
do they have to like
Alright, so I want to see a show of hands. Are we going to get started, everyone? So I want to see a show of hands. How many of you have iTunes on your computer? Do you use iTunes? Yeah? Okay, so unanimous, I think? Is there anyone who doesn't? No? Okay. Really?
wait,
Okay, well, even if you don't,
Have you ever installed a program on your computer?
yeah, okay.
Good.
That's pretty
Good.
good. So, how many of you have seen one of these before? You know, called EULA and User License Agreement, right? So they make you scroll through this really long document and you click I accept before they let you go on. Yeah. See if you nods. Does anyone actually read that?
sometimes.
Ron and I read the whole thing last night.
Yeah.
It
Yeah.
was rough.
It was
It was
rough. Good read though. It's a good story. Very strong.
33 pages.
A lot of suspense.
Printed out the whole thing.
33 pages?
Yeah.
But you know, has anyone actually hesitated before like accepting one of these things? Like, what's thought process? Does anyone spend more than about 3 seconds before hitting the accept button? No.
Yeah. So you've like read through this? Like when you install like Microsoft Word, let's say. Or...
No, not Microsoft Word. I don't even do all that stuff. I give it to my cousins or something. I don't deal with computer that
We
much.
have like a
But-
So you like outsource it.
But sometimes depends, if there are programs that, especially if I try to install it and I get an error message saying this needs your approval to allow the program to proceed or something, then I'm skeptical and then I have to read it.
So you would read the whole 33 pages?
If it, yeah,
Wow.
if I
Better than us.
Yeah. Well, I think it's relatively safe to say that the vast majority of students probably do not, right? So you know, on that note, so actually we just copy pasted the iTunes end user license agreement here. So
We've got something really interesting.
So yeah, so as we were going through this, you know, we get to
Click.
we got something about electronic transactions, blah blah blah. And remember, most of you agreed to this. If you scroll all the way down to around page 15.
What are we trying here? Should I magnify this line right
Yeah.
now?
Yeah. Sure.
What?
Oh my god.
Let me just magnify it some more. If people cannot read, then they reserve the right to sell all your personal information. Ron and I discovered this last night, so we're quickly in the process of like suing Apple. But anyway.
Yeah. So class action and all that. So this is really interesting, right? I mean, you know, none of you really stopped to read this yet. It's pretty serious stuff. I mean, you know, what do you think? What are the implications here, right? So, you know, going beyond the iTunes and user license agreement, right? So, any sort of these like vast legal documents, when you get a credit card, when you open a bank account, when you buy a car, when you purchase a home, you know, you see similar things. They're not in electronic format, but you got to sign off and say you've read everything, you've read all the terms and conditions. Right? This is a very common thing.
Even when you apply to a Rice, I'm sure there
Even
were
when you apply to
these
Rice.
form numbers.
And you know, maybe you're gonna read through a little bit more closely when you're buying a car, hopefully, than when you're installing iTunes. But it's the same sort of thing, right? And so on page 15, you could have pretty much anything couch without your knowing.
What prompted you guys to read the whole document?
Well, we kind of thought like maybe there might be something fishy, right? So we thought we should read through it. And it kind of tees up the like lesson for today. So how could this relate to like real financial stuff? Can anyone take a guess? How does this relate? How do like long contracts go? Anyone have any ideas? Right? How does something like this relate to like financial banks, loans, mortgages?
Yeah, because no one takes that for a big fine print. So as long as they just bury something deep enough and a big enough pile of legal jargon, then they're employing.
Yeah.
But I think one problem was like the floating mortgage rates, right? It's like after 2 years, we'll get you in with this 5% or whatever low interest rate, and then after that we can basically decide whatever we want. And a lot of people didn't read that part of the contract.
Exactly right.
Yeah, and so we're going to discuss that today. But the upshot is that, it's such a small thing, the fact that all of us basically have better things to do with our lives, than read these 33-page, 16,777 word license agreements. Just because of that, you can have all sorts of crazy financial terms put into these big agreements that end up causing people a lot of trouble later on and potentially precipitating a global market collapse.
All right. So that's basically tees up today's class. So, all right, but before we get into the class, right, I just want to talk about a couple of current events from last week. So, has anyone seen what is happening in Syria? Anyone want to talk briefly? So no one has followed the news. Fahad?
Over 700 people were killed by the government after the sports riot. And then the youth, I haven't really read it, it was just like push
Yeah.
notes.
Yeah.
But China and Russia vetoed.
Yeah, that's the big one.
Exactly. So in the UN, right, there's what's called the Security Council, which is 5 permanent members and like 10 or 15 rotating members. So 5 permanent members, right? China, U.S., France. No, China, U.S., England, Russia, China. Right? And basically they have a veto. Oh, did I get that wrong?
You said China twice.
China, Russia, U.S., England, France. Yeah.
Okay, you just said China.
So I don't even know. That's how important it is. So they have what's called a veto, right? So basically, any bill that's brought to the UN can be vetoed by them. So so a lot of countries brought a bill saying we're going to condemn Syria for what they're doing. Basically, they're murdering their own citizens. And China and Russia vetoed it, and vetoed that bill, basically because they have like interests in Syria, economic, military, etc. So now sort of the rest of the global community is trying to see how can they force things to change in Syria. Right? But yeah, just like Fahad said, like, thousands of people have died in the past, I guess, 7, 8, 9 months. It's really, really a brutal situation going on.
And it comes on the heel of a very different scenario in Libya, where there was unprecedented agreement between all the UN member nations and the Security Council to go in and oust Gaddafi. So it's pretty fast turnaround, and interesting to see how that region progresses. The other big piece of news from the last week or so was the release of a very big jobs report that just came out. Shows unemployment has dropped to 8.3%, which is a pretty big drop. Beat expectations pretty soundly. Of course, there is a caveat to these very strong numbers, and that is that really the number of people actually looking for work in the U.S. is the lowest it's been in many, many years. And the reason this is important, so Raj is drawing the formula. Unemployment, most people don't realize this, but unemployment doesn't take into account all the workers in the economy. It only takes into account people who are actually looking for work. So if all of a sudden you think, I haven't had a job in 2 years, I'm just going to give up, I'm already 50, 60 years old, I'm just going to give up looking for work, and you drop out of the workforce, the unemployment rate actually drops, even though economically the situation didn't get any better. So it's something we need to keep in mind here.
And the last thing, as we said, we kind of try to continue to have a watch on the Republican primary. So Mitt Romney has won Florida, and on Saturday he won Nevada. He is moving ever closer to the magic number, which I think is like 1,500 delegates. So basically each state has a certain kind of number of like representatives, or what are called delegates, and you have to win a certain number of those to clinch the nomination in your party plus you. So I think that the number is like 1,500, some obscene number like this.
It's like 1444.
Okay, yeah, 1444. So he's slowly moving closer with all these victories. And I think there's 3 more primaries tomorrow. Minnesota, Missouri, Colorado. So we'll see how it goes.
And then before we kind of move on, does anyone have any questions about anything that was discussed recently in terms of current events? No?
Yes. No, please go ahead.
No, I just remembered that I already looked it up.
Oh, okay. So you want to share it with the class with classmates?
Oh, just Facebook's IPO.
Oh yes, yeah. Okay, so we don't get to talk much about
Probably want.
Yeah, I mean Facebook's going public. With like what, starting with like a $5 billion valuation,
It's gonna get
expecting
to
to
100.
rise like 100. Yeah. Actually, yeah. Go
What
ahead.
does it mean to go public? I've heard that.
Great question. You want to think?
Yeah, so IPO stands for initial public offering, right? So basically you allow investors to buy a piece of your company, to buy stock or buy shares in your company, that's it. So then basically now not only does like Mark Zuckerberg own Facebook, like we can all, go out to the market and put in an order to buy 1,000 shares of Facebook. So what that does is it raises money for Facebook. Because like when I buy a Facebook stock for $100, that goes to Facebook. So then they can use that to expand or whatever they want to do. Does that make sense?
Yeah, prior to this, all the investors in Facebook were private, right? So not anyone can go in and buy. You had to kind of know Zuckerberg, give him a call, and say, "I'll give you $10 million."
So just for like reference, Facebook is going to be like worth about $100 billion. Exxon Mobil, right, which is the biggest company, is worth $400 billion. So the market believes that Facebook is 25% is worth 25% as much as Exxon. So you guys can decide whether that's actually valid or not. Anything else?
Was there a press release on anything about the unemployment rate, given that the number of people looking is down? What are the next steps, like, to get people actively looking for jobs again?
Yeah,
or
people
not become a burden on the economy?
did not focus on that. Really, I've never heard any policies specifically targeting to get people to start looking for work again. I think it's assumed that once people sort of exit the labor force, they're not coming back, unfortunately, because they tend to be elderly folks whose skills are not necessarily suitable for a modern economy, right? But that being said, that's not the only reason the rate dropped. I think the economy added something like 230,000 jobs, which is a lot. So it was really a combination of those two.
Yeah. And what the problem Raul's pointing out of just people just dropping out, that was a lot more pointed in the past months. But this month it was very much more positive.
Yeah.
Really a lot of job work. It was more of a job creation. But to go back to your question, the policies to get people back to looking would be like retraining them.
Yeah.
So giving them like new skills to do something, right? So maybe like give them skills so they can like retrofit a building to make it more energy efficient, and then find them a job to do. All right. Okay. So very briefly, there's this nice event tomorrow. Is it tomorrow?
Yeah.
7th? Yeah. So there's a professor coming from UCLA who basically tries to predict presidential election results based on the economy, and she has some like very detailed model or whatever, and she predicts it with like 95% accuracy.
Yeah.
Going back, right, to up to today. So she'll be coming tomorrow explaining the model and hopefully offering a very bold prediction that is likely to ring true. Though I don't know how she's going to account for the fact that we're still like 10 months up to the election and the economy can change so drastically.
Extrapolating is very different from interpolating, right?
Yeah. So anyways, feel free to drop by the event. Okay.
So with that said, we'll go into today's class. So, today is as much a story about the end user license agreements as it is a story about the markets. And the reason we open with this anecdote about the EULAs is because we want you to remember, amidst all the discussion we're going to have about economic policies and financial policies and regulation, at the end of the day, the human element is very significant to determining how the market behaves, right? At the end of the day, these sorts of quirks of humanity, right, our laziness, our real characteristics, actually influences the market on a macro level, and we're going to see that today.
So the story begins back in the 1920s and 30s, when FDR was president, and we were experiencing, as everyone knows, right, the Great Depression. So one of the things that happened during the Great Depression is what are called bank runs. Does anyone know what a bank run is? Yeah.
It's when a lot of people go to withdraw their money from the bank, and since the bank doesn't keep all their cash in reserve at that time, they run out of money.
Perfect.
That's exactly right.
So we can see a little image of. So this is a bank. There's a few people there trying to get their money out. And there's no way that a bank will have the cash on hand for everybody, right? Because banks, how do they make money? By lending your money out, right? So I mean, if you give them a deposit of $100, they don't just keep the $100 sitting in the bank. They make a loan to Rahul for $100 and charge him some interest on it so that they can make a profit.
Right. And the ratio of the amount of money the banks have on hand in their vaults to the amount of money that they actually owe is called the reserve ratio. And this is important because in a financial crisis, like we had in the Great Depression, a lot of people lose their jobs, so they become worried, so they go to the bank to withdraw money. If everyone starts panicking at around the same time, and everyone goes to the bank at the same time, then the bank can't give out all their money at once, because because their reserve ratio, they only have X percent, and I think it tends to be around what, 10%?
Yeah, about 10%.
And that precipitates more crisis because all of a sudden, people who haven't gone to the banks yet, they start to panic because they've heard that they can't get their money back, so they run to their banks, right? So it's a self-fulfilling prophecy and sort of a positive feedback loop.
So this, obviously became like very acute in the late 20s, early 30s. So FDR comes into office and he says, okay, well, I'm going to make sure that we can sort of stop the hemorrhaging, right? So he passes basically 4 kind of important acts, right? So the first one is called, I'll kind of write them on the board, though it's not, this is on the notes, by the way, which is on the owl space. But anyways, this is the first. So the first one is FDIC, right? Federal Deposit Insurance Corporation. So what this says is basically, if you put up to $100,000 in the bank, it's guaranteed by the United States government. So that is to say, if the bank goes under, or for some reason your bank can't give you the $100,000 back, the government will step in and give you the $100,000 back.
And the actual really cap nowadays is $250,000.
Yeah. Sorry. So yeah. So it began at 100,000, now it's up to 250,000. Right. So the second thing is the SEC.
Right.
Carl, you want to take this?
Yeah. So whereas the FDIC was focused more on dealing with this issue of bank runs, the SEC was focused on fundamental market regulation. Okay. So before the Great Depression under FDR, Wall Street was kind of left to run rampant, right? There really was no sorts of regulations on what could be traded and what couldn't be traded, on what investments were okay and which ones weren't. So the SEC is called the Securities and Exchange Commission, and basically, I guess you can think of it, it was the FBI of the market. Okay, so they were tasked with investigating bank fraud, insider trading, any sort of market fraud or investment fraud. Again, to ensure that all the rules and regulations were being followed. It was an enforcement wing for these sorts of rules.
So the third one was what's called the Glass-Steagall Act. This is a very important act. So what this said was commercial banks and investment banks had to be separate. So let me explain that. A commercial bank is like your ordinary bank down the street where you go to put your money in, and they make loans. It's called a commercial bank. An investment bank is kind of more like a Goldman Sachs type, where they're actually sort of in the market for buying, selling commodities, mergers and acquisitions, very actively sort of investing in the market. So Glass-Steagall said, look, let's keep them separate so that people who place their money in a local bank down the street, there's not a risk that that money gets invested somewhere else, the investment goes down, and the money's gone. Does that make sense? So separating commercial and investment banks, right? And the last one, Fannie Mae, Raul, and Freddie Mac.
Right. So Fannie Mae and Freddie Mac terms bandied a lot around 2008. But these were 2 federal agencies essentially tasked with making home ownership more affordable for Americans. Okay. So you might think, well, it doesn't really fit in the general theme of the first 3 pieces of legislation because it's not really financial regulation, right? I mean, the Great Depression, the crisis of the 1930s, wasn't really that related to housing policy, right? But this is kind of thrown in an effort to make housing more affordable for Americans and to sort of meet this idea of the American dream where everyone can own a car and a home and family of 4, right? So this was a big policy initiative that was very popular. And what Fannie Mae and Freddie Mac were tasked to do, they were essentially government banks, public banks, focused on mortgage loans. And they were able to offer very reduced rates to Americans, again, to promote the housing market.
Yep.
Yeah.
But actually, couldn't that have been in the theme with their other pieces of legislation? Because with Fannie Mae and Freddie Mac, the government was encouraging people to be homeowners. So basically investing in illiquid assets that you wouldn't have on such things. So you have a lot of your assets tied up in a big home or something. You're not going to actively be going to the bank and withdrawing your assets.
That's true. That wasn't the intention of the legislation.
That's very good analysis.
That's a great point. But what ends up happening is it somewhat backfires, and we'll get to that in a second.
So, by the way, liquid assets are sort of ones you can sell like tomorrow. So a stock is a liquid asset, right? Because I can sell my Walmart stock tomorrow. There will be someone to buy it. Illiquid asset is like a yacht or a house. It's going to be kind of tough for me to sell it on a dime if I need to, right? So cash is obviously the most liquid thing. Right? Okay. Good. So now we're going along, and this is working really well from the 30s, 40s, 50s.
Several decades.
Everything is going really good. I mean, American growth is very strong. Things are going great. Then we get kind of to the late 70s and early 80s.
Right. And this is around the time that these sorts of basic set of the financial regulatory wing of the federal government, it starts to change, okay? And this change starts with something called the Community Reinvestment Act. So this was a bill passed in 1977. And it didn't have to do directly with financial regulation, financial reform, but it's what precipitated a lot of changes that happened later. And just to backtrack, the Community Reinvestment Act ended a practice called redlining.
So redlining is where banks would say certain areas of a city, right? They would literally draw on a map a red line around it and say, we are not going to make loans to this area because of like racial reasons, economic reasons, whatever it might be, right? So this act said, you know what, you cannot do this anymore. You can't just say to certain people, hey, we're not going to give you a loan. That's discrimination, right? Economic or racial. And again, remember, this is coming on the heels, basically like 15 years, I guess, after Civil Rights Act. So it's kind of still in that sort of time period, right? And it basically saying, look, you can't discriminate on the basis of race or income with regard to loans, right? So there's positives and negatives.
Yeah. So, you know, on the surface, it seems like a very innocuous bill, right? I mean, it's a good thing. I mean, this discrimination needs to stop. And it was, again, for a very, since it was a very short period of time after the Civil Rights Movement, this sort of racial discrimination was very common. But the bad side is, what ended up happening, one of the unintended consequences is that the banks overcompensated. Okay, so in response to the bill's challenging of the banks being able to block off certain districts, banks had to prove that they weren't discriminating. And how they ended up doing that was by overcompensating and giving mortgage loans to a lot of people who realistically could not afford them.
Okay, so everyone's good so far with his story. So now,
So this is something you have to hang on to because it really propagates about 30 years later. Okay, so just hold on to that for a second.
so now we start entering the 1980s, and we see the global emergence of what's called the Chicago School of Economics. And this is really popularized by a guy named Milton Friedman.
Right, so the Chicago School of Economics is pretty simple. And one of the basic core tenets was we need to deregulate. Okay, so shrink the size of government, cut regulations, get the federal government out of the way, and businesses will start to grow. And, you know, this really changed the FDR Keynesian style of economic thinking where active government investment was the norm, was the mainstream economic thought. Whereas now, sort of in the 1980s and the 1990s, deregulation became the mainstream school of economic thought. And what ended up happening was that this sort of Chicago School of Economics exerted great influence on economic policy in Congress and in the White House.
And probably the most important one occurred in 1999 with the repeal of the Glass-Steagall Act. So just remember back to a few minutes ago, we said, remember Glass-Steagall was what said commercial banks, investment banks, separate, right? So your like bank down the street cannot be doing, you know, what Goldman Sachs is doing, mergers, acquisitions, whatever it might be. But because of this whole deregulation mantra, deregulation sort of movement, right? The Glass-Steagall Act was repealed, and commercial banks and investment banks were again allowed to come back together under one roof, right? So there'll be a local bank down the street, right? Takes whatever money you get, gives it to another branch of its own bank that's then, you know, doing mergers and acquisitions and investing in different commodities, whatever it might be, right?
And the idea was that this repeal would allow the financial sector to really boom because you had more capital flowing back and forth between consumers and investments, and you know, it would create economic growth, right? It's a very Chicago School standard economic principle. But one of the consequences of this legislation was that it led to a consolidation of banks. So all of a sudden, your consumer banks that you would go and deposits to, it would start to merge with these investment banks. And you would have these massive few banks, 6, 7, 8 banks, that would just dominate the market. Simply because they could get sort of the economies of scale necessary to maximize their investment.
So, you know, we're going along, this happens in 1999, and then we get to 2001. And some of you guys might remember there was sort of a mild recession then, right? You had tech bubble burst, right? We had a 9/11, so sort of confidence went down a little bit, and there was, you know, a dip in economic performance. So the Federal Reserve did exactly what we would expect it to do. So remember, think back back to 2 weeks ago. Remember the lecture we had on the monetary policy? So Federal Reserve wants to stimulate the economy. Does anyone remember what they would do? They want to help economic growth.
Lower interest rates? Lower interest rates?
Yes, exactly right. Perfect. That's exactly what they said. Okay, we're going to lower interest rates, right? So more people take loans, and then more people will spend more. The economy will start growing again. So that's a very good on the surface policy idea. However,
Right. And at the same time as this was going on, once again you had President Bush Jr., who made a big push as part of his political platform to have, again, a house for every American, right? So there was great pressure at the time, and this is popular in Congress as well, right? It's not just President Bush, but it was great pressure to ease interest rates and to ease access to mortgage credit via Fannie Mae and Freddie Mac, the government banks that we talked about.
so low interest rates from the Federal Reserve, right? President Bush saying we all got to have a house. That's part of the American dream. China, right, is beginning to rise economically, so they have a lot of money. So what do? They put it all in the United States. What does that do? If people are investing in the U.S., remember the interest rates go down even more. So you guys remember we saw that chart from last time where like 30-year rates were down to like 1 or 2%. Same thing was happening back in 2001. We also had huge influxes of what are called petrodollars. That's money from oil-rich states, so like Saudi Arabia, UAE, coming into a lot of money. They were investing that back in the U.S. So essentially we had really, really low interest rates, a lot of money floating around, and government policies to try to get every person a home. So this is a perfect storm for homeownership.
Right. And so, throughout the early part of the 2000s, we had mortgage interest rates at record lows, right? It was one of the easiest time periods in American history to get a home. And one of the offshoots of this, in the aggregate of all these forces coming together, were the creation of what were called subprime mortgages. Okay, so this has become a very commonplace term these days, but subprime mortgages, in many ways, were really at the heart of the housing bubble that we saw in 2008. And a subprime mortgage, it's a fancy term, but it means something very simple. It means a teaser rate.
So the bank says, hey, we'll give you a 2% interest rate on your loan, but then they write in the fine print, page 16 of 63 pages or whatever it was, right? They'll write, but the rate's going to jump up to 20% in 2 years. If you miss a payment by a week, the rate goes up to 20%. But of course, no one read that. And it's couched in this financial jargon that is very difficult, even for us to understand. We're, relatively intellectual college students. If you talk like the average person doesn't have a college degree, right, or doesn't have a high school degree, whatever it might be, very difficult to understand the language. It's very, very, and now you guys know, like small print, legal, like language, it's hard for us to understand, right? So what happens then? People are like, all right, sign me up, 2%, loan, I can buy a house. This is part of the American dream.
Right. And so as a result, the housing market booms. It booms. Prices just go through the roof. And everything's going great, because if you buy a house, it's the greatest investment, or one of the greatest investments you can possibly make, because the value is guaranteed to rise. Take a look at this curve, right? So this is starting year 2000 here. Just a rapid rise.
Yeah, so this is the percent change per year in sort of like housing prices across the nation. It's called the Case-Shiller Index. It's not that important. But just look at this steep, you start here and look at like 2006, 2007, boom, look at this rise.
Yeah, your housing value is growing at almost 20% per year. It's hard to find an investment that generates those sorts of yields, right, on a consistent basis. So, and everything's going great because you take your mortgage and your house value keeps rising, so then you can use your house as collateral for loans for other things.
Right, so does everyone understand kind of what this means? This is basically saying, so look, I have a mortgage on my house, and my mortgage is for, let's say, $1,000. So that's how much I paid for the house. But the house is growing in value 20% every year, right? So at the end of year one, it's worth $1,200, right? So I bought for $1,000, right? At the end of year one, it's worth $1,200. So what I tell my bank is I say, look, you can give me a loan for $200 because I have $200 more, right, in the value of my home, right? Because now, like, my house is worth $200 more, right? So I basically say, okay, you can give me a loan for $200, and then I take that $200 loan and go buy a TV or a car or whatever it might be. So using the increase in home prices to buy, some other goods. Does that make sense to everyone? Sort of like using the home that money to buy whatever I want to buy. And I get that in the form of a loan from the bank.
So then just to recap, what we see, again, in the early part of this decade is a confluence of a few main factors, right? Easier than ever access to credit. Folks getting loans that probably aren't in the greatest financial situation to pay them off. And essentially using the fine print to get people further in debt with an exploding bomb, right? Interest rates that are going to spike up dramatically after a 5 to 10 year period, in which case they're even more trouble. Right? So these are sort of the factors at the grassroots level that are basically influencing a very good chunk of the American housing market. Yes.
Joseph, which bank was it that y'all, was that the Fannie Mae and Freddie Mac that y'all said that had the 2% to 20%?
So they all did that.
Everybody?
Yeah, I mean, everyone's doing this, right? Because I mean, you want to like make money, right? And you're just like, hey, I'll just like pass these loans off to people. I mean, if they're willing to sign them, hell, I'll sign them up, right? Because I mean, the home prices are going to keep going up, so there's no risk, right? I mean, because I mean, it doesn't matter what the interest rate is, because I mean, as long as the home price keeps going up, you can always sell the house, pay off the mortgage, and you're set, right? So then you can have whatever interest rate you want. And then the banks got smart, and they were like, you know what? We can even make more money, right? And this is when things got really interesting. So as Raul described it, I'll draw a diagram that will go over it.
Yeah. So this is where things get fun. Okay. So at the same time that all this is going on the consumer side, right, on the average side of the average American, the banks get a little creative, and they think, well, you know, we're getting all this money from all these mortgages, which is great, but let's try to push the profitability. Okay. So they create what are called CDOs, or collateralized debt obligations. And the basic idea is that they're like, you know, these mortgages, they might make pretty attractive investments to other investors. Okay, so if there's some rich businessman in China who needs a good place to put his money to invest and to get some good returns, they're like, well, maybe we can facilitate that. So what they do is they bundle up these. Well, the very first thing they do is they go to a ratings agency. Okay, and they say, okay, we have these investments. We're going to give you $10,000. Could you please rate the quality of these investments? So I guess Fahad, we'll use you as an example. Okay? So if I say, Fahad, I want to sell my laptop. I need to put a rating on the what's it, Owl's list can rate on 1 to 5. I need to put a rating to describe the quality of the laptop. So for that I need like an external validator. I'm going to give you $1,000 to rate my laptop. What rating would you give it? Yeah. Because, if I don't get a rating that I like, you're probably not going to see the money. And if I do get a rating I like, you're throwing a little something extra, right? So, in reality, these rating agencies, which are supposed to be independent and rational and objective and external, are financially incentivized to not be. Okay? So they gave these mortgages what are called AAA ratings, which is the best of the best, right? Which is the A+ rating. And because these rating agencies were hired by the banks themselves, all these mortgages, no matter who they were given to, no matter at what rates, no matter whether they're subprime or not subprime, they were all given pretty much uniformly AAA ratings.
Okay, drawing is basically ready.
Okay.
Okay, so let's kind of go through what is happening here. Can people kind of see the drawing? I'll just walk through it. Okay, so 3 neighborhood banks, okay, and these are, 3 people, right? My beautiful artwork, right? So these 3 people, they go to their neighborhood bank for a loan, right? They want to buy a house. Bank gives them the loan, right? And then the bank does exactly what Raul says, right? They bundle them all up into what's called a CDO, collateralized debt obligation, right? And then they tell the rating agency, right, here's the $100 grand, give me the rating on this. So of course it's given AAA, right? And they sell this CDO to a Goldman Sachs, Morgan Stanley, something like that, right? And then Goldman Sachs says, okay, well, we'll combine 2 CDOs. I mean, it's obviously more than 2. It's like 100 they combine into what's called a derivative, right? So they combine all the CDOs into a derivative, right? So before we had the CDO, which had some loans from subprime people with also, grouped together with some other good stuff, right? And now you have the CDOs, right? You have like 20 CDOs all grouped together to form a derivative. Goldman Sachs goes to the rating agency and says, here's $100,000, why don't you rate the derivative, right? What rating does that get? AAA, very good. And then what does Goldman Sachs do? They say, you know what, let's sell the derivative to some other investors. They sell it to people like AIG, right, the insurance company, right? And then what does AIG see? They see, wow, this is a derivative, it's rated a AAA from Goldman Sachs, very reputable company, good investment, right? So they make the investment. Problem is that Goldman knows that these are not worth AAA, right? So what does Goldman do? They tell AIG, you know what, since you're an insurance company, we want to buy insurance in case this goes down in value. So if it goes down in value, then you will pay us, right? That's how insurance works, right? If you get sick, or the insurance company pays you, right? So Goldman said, hey, we're selling you something, right? But at the same time, we're going to insure against it, its value going down. AIG's like, something's rated AAA. Hey, I'll sell you insurance for that all the time. So it's just AAA. It's a freebie. It's a freebie, right? The value's not going to go down. It's AAA. It's really good, right? So basically, does everyone kind of see how this picture comes? Yeah, question.
Does AIG not do any sort of investigation on this?
No,
The way you're explaining it seems very simple.
Because this is like companies like Fitch, S&P, Moody's,
All
are
very reputable
very like reputable companies.
And Goldman Sachs is also
huge
very
company,
reputable.
right? So we don't need to worry about this.
We have a few
Question
questions.
here, yeah.
So, how do they get insurance on something they're selling? I mean, they're giving it to AIG, so AIG should be worried about the price going down. Why is Goldman Sachs worried about it?
So I can insure anything, right?
Yeah, you can literally insure anything. And so just as a good aside, I mean, what people don't realize is that all sorts of things are insured. Okay, so when Nike gives an endorsement deal to an up-and-coming basketball star, they say if you get to the playoffs, we'll give you $1 million bonus. Okay, they insure that. They go to an insurance company and say, if this guy gets to the playoffs, can you insure it and pay us some of it back? So it's a way of hedging the bet. Because if he actually gets to the playoffs, they don't have to chunk out $1 million, they only chunk out $100,000. Does that make sense? Yeah, so the same sort of thing happens with Goldman Sachs. They say, okay, we're probably going to make money on it, but if it fails, we're going to lose a lot. So why don't we hedge it and narrow the volatility? And we do that by buying insurance.
All right, I'll give you another example, right? So let's say I came to you, right, and I said, here, I'll give you $100, right, and you pay me $200 if tomorrow Rahul Rekhi becomes a girl. You can, okay, so I'm insuring against Rahul becoming a girl.
Probably not a great investment.
Right? So you're going to take that deal, right? Because then you only have to pay me if he becomes a girl tomorrow. He's not going to become a girl tomorrow, right? So you're going to take the deal. So this is what I'm saying. You can insure against anything.
So if Goldman Sachs knew that these investments were not good, why did they buy it in the first place from the bank?
Because they knew they could sell it to AIG and make money on the sale and on the insurance, as we're going to see.
So going back to her point, that if AIG can rely on the reputation of those companies and not do their own research, but Goldman Sachs does, then if AIG has to pay it, they're paying for the stupidity and nothing else.
Well, but they're also paying
it's
for the
also
fraud,
fraud.
right?
Yeah.
It's fraud, right? Because I'm selling you something that I know is bad.
Okay, but then if you don't know that it's bad and you did not do your own research, and then you're trusting companies that are not regulated by anything.
Well, so keep in mind that, so this all seems very clear in retrospect. Okay? Being the armchair quarterback here, but prior to this whole crisis, these were great deals. I mean, look at it; it's going up 20%. You have to be an idiot to refuse.
This is like insuring against him turning into a girl.
It's
Everybody would
easy,
take it, right?
It's easy money,
Free money.
It's easy money, and trader is not going to turn that down.
Yeah, back end.
If these rating companies are so reputable, why did they sell out on this one?
Because money talks.
And why didn't they do that previously?
So they did, right? But bubbles don't happen all the time. And it takes a very particular set of conditions, like a perfect storm, for all these things to coalesce and cause all these rating agencies and all these companies to collapse at the same time.
And by the way, at this time you also saw a lot of rating people coming to work at Goldman and vice versa, more than before.
Yeah,
That also,
it actually.
yes.
I think the other issue with this was that I don't think the banks understood it entirely either, because
No, they
that's why
didn't.
they went under, because they didn't hedge it enough.
They didn't. So
And neither
yeah.
did the rating agencies.
So
No
we're
one
probably
understood
giving
it.
Goldman a little bit too much credit. They didn't know everything, right? So parts of Goldman knew. Maybe some traders had a hunch, some didn't. But they insure most of their investments anyway. And so you're right that if they really knew, they would have insured the whole batch. Here they insured part of it with the AIG.
Max, Scott.
So let me get this straight. guys like Goldman sell to guys like AIG,
Correct.
big bundle of toxic crap, and then they take insurance
Who's they?
off on it. So they're paying them insurance, but they're betting that it will fail so that they will get money back from AIG in case it fails.
Right. Correct.
And in the meantime, AIG is going with it because they got this giant bundle of good rated stuff. At the same time, they're getting insurance money from Goldman,
Exactly.
and they don't see anything failing. So,
Exactly.
so one is betting that everything will tank, and the other one's betting that everything will.
Exactly.
And one knew that things are probably going to tank.
At least in part.
At least in part.
We had another hand somewhere. Yes.
Oh, what was the government backing kind of thing? Why would the neighborhood bank want to make these loans in the first place if they knew that their likelihood of getting paid back was low?
Because when the home prices go up, it's good to make loans, right? Because then it can always be paid back. Because then I can just like take the house. If you don't pay back your loan, I'll just like, take the house, sell it on the market, and I'll be fine.
You'll make more.
Because as long as the price of something is going up, then it makes sense for me to make you a loan for the good.
They just repossess the house.
I just repossess the house.
Wasn't there government incentives to encourage loan making when there otherwise wouldn't have been?
Yeah, there were. Like we were talking about, there was a lot of
Fannie,
pressure,
Freddie, all this
especially
stuff.
on Fannie Mae and Freddie Mac to give out loans.
Exactly.
Those are public banks. They're more in the purview of the government. Private banks have more leeway, but they were incentives.
No, yes, please.
What did y'all say the collateralized debt things were again? The CDOs?
So that's when you combine subprime mortgages with some other assets that are probably good, right? So it's like combining 3 subprime mortgages with like 1,000 shares in like Walmart, right? So the 1,000 shares in Walmart are like, they are definitely AAA. Walmart's not going anywhere, right? So you sort of combine all that into the CDO, combine the CDO's derivative, sell the derivative. Yes.
What did you say subprime mortgages were again?
Subprime mortgages are when, so I make a mortgage to you and it says 2% for the first 2
that's
years,
the 2% to
page
20
60, yeah, exactly, 2 to
Okay.
20. Then on page like 60 it says, if you miss the payment by a day, go to 20%. Yes,
Where do rating agencies come from? I mean,
it's private, they're just like private companies.
and so they're rating stuff for sellers, not for buyers.
No,
So-
so they're hired by the sellers, but the information is viewed by both. Does that make sense? So like Rice can like hire like an accrediting board, right? To like, I mean, value Rice, right? Or say like Rice is a good school. So like Rice is doing the hiring, but it's also like for all of us to see that like, okay, Rice is accredited by this company. And here's the thing, I mean, during all this like time, these rating agencies were like building up huge credibility, right? Because they were always doing the right thing, right? But when the perfect storm came, it can go so wrong. Yeah.
So you might be getting to this, but you said what Goldman did was fraud.
Yeah.
Can you explain like why they can't do that? Like why can't they mislead people if it's to their benefit? Why do they get punished for being smarter?
So it's a very good question, right? And I will say, wait 5 minutes and you'll see the answer, probably, or 10 minutes maybe max. Right?
Also, one last.
Yes, please, no, come on.
So basically, like going back to what y'all said about the perfect storm thing,
Mhm.
all of this diagram happening can occur because the Glass-Steagall thing got eliminated, right?
Correct.
So the
In
neighborhood banks, like those are the commercial people, and then Goldman Sachs is the investment, and they would not be able to sell to each other if the thing was in place.
Correct. Correct. And I mean this like does not have to be Goldman, right? So this could be like Bank of America, which like also is a neighborhood
Yeah,
bank.
and they were all doing that.
They were all doing it. I only pick it at Goldman because it's like we all like know about it. It's just kind of the most well known, right? All right.
Okay, so all this continued, and it's all great, right, for many, many years. And then 2008 things start to change, okay? So for whatever reason, housing prices start to fall. You might think, well, you know, what spontaneously causes things to fall? Well, it's kind of like the bank runs, right? It's a positive feedback, like a snowball effect, where you see a critical mass of people starting to sell off their homes, which drives home prices just a little bit down, which freaks people out, and then they start selling their houses, and it precipitates in just a dramatic drop, and we see that here on this graph.
Case Schiller, it's right showing this. So, I mean, can someone see the like stack of cards kind of falling down right here now? Right. So what now happens is these guys, right, have to pay Goldman because the derivatives are kind of worth less. right? So they're basically falling apart. And then you had people who are also doing this who who did not do the insurance thing, right? So there were other people over here. I'm thinking of people like Lehman's, right? And Bear Stearns, right? They didn't see this coming, right? So they didn't do the insurance. So if you didn't insure this, right, and the value of these things are going down, you're in deep trouble, right? Because then the value of your investments is decreasing, because the value of these CDOs are all decreasing because people are defaulting on all these, right? So the home prices are coming down, people are defaulting on the mortgages. If people default on the mortgages, the value of the CDO declines, right? Because these are bad investments that are part of the CDO. CDO value declines, derivative value declines. Derivative value declines. Either you get screwed because you're Lehman and Bear Stearns and you didn't insure it, or you get screwed because you're AIG and you insured it and you bought the derivative. So if you're AIG, you really got screwed. And that's exactly what happened.
And that's really what happened, right? So they went out at a bang. Bear Stearns and Lehman, again, they went out very, very quickly. Did not survive long at all. And this precipitates all the way down to community banks, right? Because all of a sudden they're hit hard too.
These guys.
Right? The local guys. And then, of course, the homeowners themselves, right? All of a sudden, their net worth diminishes just like that. So very, very quickly, also Freddie Mae and Freddie Mac, also they take a huge loss.
You can view them as one of these guys.
Yeah. So at the same, simultaneously, everyone across the spectrum takes a huge hit. Okay.
Right.
So,
and by the way, this is happening Lehman collapsed on September 15th, 2008. Right. So remember I said last time, right? There was an article. What's going to be the bigger date in history? September 11th, 2001, right? Or September 15th, 2008. So I guess posterity will decide that. But anyways, right?
So things happen very rapidly. Okay? And this is all happening in 2008, especially late 2008 with election pressures, right? With the Obama-McCain election. Now, President Bush and his administration obviously go into crisis mode. Okay? They think we got to stabilize the market, we got to do something, and they take a pretty big measure, something called TARP. TARP stands for Troubled Asset Relief Program. The actual acronym isn't too important, but what you need to know is that TARP had a very simple idea, was that we got to get, as Max called it, the toxic crap off the bank's balance sheets. So what the government did was step in and buy these bad investments from the banks. They said, okay, we'll pay you for them. They're a bad deal, but we'll give you the money so you can continue to loan to small businesses and make investments and inject money into the economy, that you don't collapse.
So is everyone clear on the goal of TARP? We'll buy your crap, and we'll pay you not the crappy price for it, we'll pay you the original price. So we will take the U.S. taxpayer, will take the loss, and then you, the private bank, right, can then make loans to people to get the economy going. So it was a really, really good idea in theory, right? But things are always good in theory. In practice, it failed miserably because the banks did not have any strings attached to the money they were given, right? So basically, they were just given a blank check, or not a blank, there was an amount check, right? They were given a check for a certain amount, right? And there were no strings attached to the money.
And so what ended up happening was, instead of using the money that they were given to make loans to businesses, to invest in companies, to do all these sorts of market simulating things, they used that money to buy other banks. So they took advantage of a bank like Goldman Sachs, or, I guess they didn't really merge, but some of these other banks, the big banks, they noticed that some of their fellow banks, which took a really, really big hit from these investments, were very undervalued, right? Because the companies took a big financial hit. So it was a great deal, right? Because as an investor, what's the number one investor mantra? Buy low, sell high, right? So they thought this is a great opportunity to just buy up our competitors. And that's what they did.
So, for example, you'll never see Washington Mutual anymore, because that was bought by J.P. Morgan Chase, right? And you'll never see Wachovia anymore, right? It's bought by Wells Fargo. And you won't see Merrill Lynch anymore. It's bought by Bank of America, right? We can go on and on and on, right? So this is exactly what's happening. And then, so now the fundamental question becomes, why were there no strings attached, right? Why did this happen? So this is what's called a government failure. Technical term, government failure, technical term, right? And why did it happen? Well, because people from Goldman Sachs, right, were working in the administration. So Hank Paulson, who's the Treasury Secretary, so basically the guy who designed TARP under President Bush. Can anyone guess where he was CEO before he was Treasury Secretary? All right, Goldman Sachs. That's exactly right, right? And even in Obama administration, people here are also from Goldman, ex-Goldman officials.
Yeah, and so we don't need to paint the idea that everyone's sort of evil and on the payroll.
And there are good people at Goldman. Sorry, I hope no offense.
Because the argument, people have gone back and said, well, why didn't you put strings attached on this legislation? And their argument was, well, if we said some sort of stipulation that they had to loan the money and inject it into the economy, then the banks wouldn't have taken it. And again, I mean, it's up to you to sort of determine whether this is a convincing line of logic or not. But that's the devil's advocate argument. But what is clear is that there is this essence of a regulatory revolving door, where you have the regulators and guys like Hank Paulson who work in the private sector, who are closely affiliated with the private sector, namely these sorts of investment firms. And there's this back and forth where they're strongly influenced by what their friends over at Goldman are saying. So that's an open question. But the reality is,
wasn't there a quote that said the regulated became the regulators, right? So Goldman Sachs and all these banks were supposed to be the regulated, but they became the regulators because they were the ones actually shaping the government policies. Right. They were the ones in the meetings. Right. So anyways, this happens, right? And then, as you guys all know, right, President Obama comes into office early 2009, right? And he says, okay, we have got to do something so that we never have this problem again. TARP said, let's stop the bleeding. It didn't say, let's permanently cure the patient, right? So President Obama said, hey, we're going to pass something that's going to permanently stop this. This is never going to happen again, and we're not going to have another sort of big recession like this. So he tried to pass, or he successfully passed what's called Dodd-Frank.
Right. And so Dodd-Frank, commonly called the Financial Reform Bill, passed mid-2010, July 2010, and it basically had 4 key principles of sort of preventing a crisis like this, at least in theory, from happening again. The first very simple requirement was to decrease leveraging from the banks. Okay, so what we talked about earlier with the reserve ratio is that banks lend out will only keep on hand a certain percentage of their money that they actually have, right? So Dodd-Frank said, okay, you got to increase that percentage, increase the reserve ratio, keep a greater percentage of your assets in the vault, so that when there's a crisis, you have more money to, again, continue to make loans and keep the economy running. Okay, so that was the first big principle.
So the second part of it was called the Consumer Financial Protection Board. So I just wanted to write it. So the second one was called the Consumer Financial Protection Board, or Bureau, right? And basically, what was the goal of this? The goal of this was to say, look, we got to stop this practice by banks, right, of putting small print on page 16 of the 63-page document. We got to stop this. This is unfair to people, and people don't understand it, right? So the goal was that the Consumer Financial Protection Board would become like the FDA is to prescription drugs, right? So the FDA regulates drugs, right? So like make sure that we don't all get sick when we take penicillin or Tylenol or whatever it is, right? So the same hope was that the Consumer Financial Protection Board would regulate financial contracts between banks and consumers, between credit card companies and individual people, payday lenders. I'm sure you guys are all familiar with this, right? It's basically these are guys who like lend you money before your payday, charge you ridiculous interest rates. They're basically like loan sharks, right? And the goal is again to like regulate all this, and they basically get someone to sort of do some real significant oversight.
And third big piece is to increase the transparency of these derivatives. Okay, so as Raj mentioned, these were these sorts of like super packaged financial instruments that are being traded between these companies. So what Dodd-Frank said, okay, you got to trade all these on some sort of public market that the regulators can look into. So not just sort of internal private dealing. And again, this is just to allow the information to be public and to allow like any sort of crisis to be predicted beforehand, so the government could look in and see what was going on. And then the last big piece was to end this notion of too big to fail. Okay, so one of the big issues with this crisis, because of the bank consolidation that we talked about, you had a few big banks whose collapse meant a systematic economic collapse, right? Because these banks were so big, they controlled so much capital and so many investments, the collapse of a bank like Lehman and Bear Stearns and some of these other banks
practice, government failure again, right? So what happened? Again, as we talked about, this regulatory revolving door, right? So these big banking companies, right, are part of the government regulatory bureau, and these are the banks that donate heavily to congressmen, right? So, I mean, if your biggest donor, right, is a bank, and that bank, right, is like giving you thousands and thousands of dollars for your reelection campaign, which happens every 2 years, you need a lot of money to run, you're not going to pass something that, I mean, they don't like, right? I mean, it's just that simple. And I apologize for being so cynical, but that's basically what happened, right?
The other big aspect is.
Here's a question.
So wait, the actual policy didn't fail, it's just that it didn't get passed, or what?
No, okay, so
We're gonna
we
explain.
should preface
Oh,
it.
yeah.
What ended up happening was Dodd-Frank ended up being very watered down. Okay, so both in its passage and when it's being implemented. So keep in mind that when a bill gets passed, that doesn't mean that the regulations are already written.
It doesn't mean it happens like this.
It doesn't mean it happens like that. So in between a bill's passage and when it actually, becomes law in the form of some sort of regulatory rules at like the FCC, there's a big leeway of time that allows lobbyists and other folks to come in and say, well, you got to tweak this part of the bill here. And no, this piece of legislation won't work because it's not going to happen. And so over this period, more often over time, and to this day, in fact, Dodd-Frank became more and more watered down for the reasons that we're outlining.
Right.
So the other big reason is really a flaw endemic to regulation as a whole, and it goes back to this idea of regulatory revolving door. But the reality is that the regulators themselves are not incentivized to do a great job. And this isn't immediately obvious, but take a step back here, okay? If you're the SEC chief, and you're talented, you're smart, you're capable, you know all the rules of financial, of government, federal financial regulation in and out, right? What's stopping a bank like Goldman Sachs, which has tons of money to throw around, to say, come work for us, we'll give you $10 million a year? There's nothing stopping them, and it's a good deal for them because if they have someone who's an expert on all these rules and regulations, someone who's smart, someone who's capable, they're actually going to save money in the long run, right? It's cheaper just to hire the guy than to have to fight the regulations through lawsuits to the courts. So and unlike many of the other policy problems that we talked about in this class, there isn't a great solution to this.
So, I mean, easy solution, right? So I'm like, hey, Raul, why don't I just increase the pay of the regulators? Then they're going to stay with me, right? So then the government's set. What's the problem with that?
Well, Goldman will just pay the regulators even more.
Right, so that's the problem.
It's an arms race that the government can't win.
Right. So we had that problem. I mean, and we don't want to get too much into this. I already see that the time's running out. But the other thing that happened, I think, and we'll just skip to this, is this Consumer Financial Protection Board was filibustered. And a filibuster, again, I think we've touched on it in the past, is basically where in the Senate, in order for anything to get passed, there need to be 60 votes. Right? That's just an obscure provision. It's actually not part of the Constitution. So there were not 60 senators who supported this becoming part of law and would not basically let it do its job, so they just continue to block it. So as a result, this could not, regulate those loans, contracts, the credit card company, the payday lenders. So this became basically, inept.
Right, for a very long period of time. And it gave the banks more time to step in and water down the regulation before it actually got approved. Actually, the CFPB just got appointed its head, Richard Cordray, back in January, so about a month ago. But basically, almost 2 years after the passage of the bill. So pretty big length of time there.
So, before we end, we wanted to just give you guys a couple amazing quotes, right? So everyone knows who Warren Buffett is, obviously, right? So the greatest investor ever. So he called derivatives financial weapons of mass destruction, right? So that's obviously hyperbolic, right? But it's very emblematic of the damage, right, caused by these derivatives. And then Alan Greenspan, who you're probably not familiar with, he's the former head of the Federal Reserve under Bush. So he was remember we talked about Ben Bernanke before we showed you the picture of the guy, right? He was Ben Bernanke under Bush in 2001. So remember, think back 20 minutes ago, we said in 2001, interest rates really low, right? stimulate growth, right?
That was done under Greenspan.
That was under Greenspan. He famously said, after the fact, we relied too much on the private sector, right? So easy for him to say now, very hard to see this happening 10 years ago.
So, there's questions to be asked here, right? So there's really an infinite number of good discussion topics. Should we have, is stronger regulation the answer? What, like you mentioned earlier, sorry, what was your name? You had brought it. Julia? You had mentioned the issue of, was it fraud, right? These are all questions that, again, are somewhat open-ended. The bigger issue is if such a crisis happens again, right? So maybe not in the housing market, but if there's another sort of perfect storm where you have bad investments that are underregulated that can precipitate a financial crisis 10 years from now, is the government equipped to come in to step in and prevent it from happening? The answer is we don't really know. But what is clear is that Dodd-Frank, because it was so watered down, the chances that such a crisis would be able to be prevented are markedly lower than the outset of the bill.
Than what they could have been.
Than what it could have been and probably should have been.
So there are so many things you could possibly think of to ask, right? So should people from Goldman be banned to go to the regulators, right? Should banks not be allowed to give campaign donations to congressmen, right? Or should these rating agencies just be sort of like abolished, and should the government just do all the regulating? But you could think of infinite questions, and they're infinite answers, and there's really no right answer.
But maybe we just want to take a few minutes, 5 minutes or so, just say our thoughts, right? So we had a lot of questions earlier this class, a lot of very good sorts of topics of discussion. But what do you guys think, right? So, can we prevent such things like this from happening again? Or even on a very simple level, does regulation get in the way of financial innovation to where even if we're accepting the risks of these sorts of crises from happening, it's still worth it because financial sector booms, startups get their capital. There's arguments on both sides. Earlier when we brought up Facebook IPO, part of the reason Facebook can get this $100 billion valuation is because of these financial markets, right? There's a lot of capital to allocate, and it made Mark Zuckerberg and his many employees very, very rich, right? For providing some service of perhaps dubious value to the economy. But the point is, there is a cause and effect to these regulations. But when have we been very vague? I mean, does anyone have any general thoughts on what was discussed today going forward?
Any questions?
Any reactions?
Any reactions?
I have a question that you guys didn't quite touch on it, but I see it in your outline.
Yeah.
But you were going to talk a little bit about CEO pay.
Yeah.
And I don't remember exact numbers, but I remember once a professor talking about the fact that I think it was Japan.
Yep.
The CEO to worker pay is about the CEO would never make more than 15 times or something what the lowest paid worker makes, and then in the U.S. it's over 300 times
Yeah.
what the lowest paid worker makes.
I can understand.
And I was just wondering, is that a cultural thing? Is that a law? Do you have any thoughts on the differences between why that doesn't happen in the U.S. and
Yeah, that's a good question, and the answer is no one's quite
Should
sure.
we table it for next week?
We're gonna table for next week simply because next week we're gonna talk a lot about income inequality and income distribution in America and sort of differences that we see between, like you said, the top earners, like a Zuckerberg versus the average worker. We'll talk more about that, but it's really complicated, but we'll get into the reasons.
But the stat is exactly right. So what we're going to talk about just is that CEOs basically are paid in what are called stock options, right? So they can cash in their shares in the company, right? So if that's how you're paid, your motivation is only to drive up the stock price. That's it, right? So what drives up stock price? Good short-term performance, not good long-term performance. So if the stock price, starts here when you take over, and you can get it up to here in a month, you'll cash out here. You don't really care what happens over here, right? So because CEOs are paid in stock options, that incentivizes very high risk, high reward for things that can have huge sort of tails on them.
Yeah, and that's what we want. The reason that allow these risky bets to keep happening if they knew what was going on, because the long-term performance of the company is immaterial. Bob, you had your hand up.
I don't really have an argument against this battle that's like man between man.
Right.
Clearly, whoever has more information and more power is going to win. But I do hope that like from all this mess, like for example, how the Occupy movement started, that
Right.
people become more knowledgeable. For example, about the consumer fraud protection bureau. That we can, as a nation, like, sort of fight for this. For example, like, if there are people who have money, but at the end of the day, Congress are not there for the support of the people.
Right.
And so maybe the Occupy movement can start pushing for something like that, like instead of something random, like.
Well, here's my question, right? Is there anyone in this room who actually came out to the Occupy Houston protest?
Oh, we need to show the video. So next week we'll show the video.
Yeah, yeah.
There was a Rice student who got arrested. Did you remember that? Really? I'm not kidding, right? What's his name? Guy Jones. What is his
Should we single
name?
him out?
Ed. I forget his last name. His name's Ed. Anyways, he got arrested there, so we'll show the video next week.
Anyway, the reason I bring that up is because, you know, if this is something you feel strongly about, you gotta go out there, right?
Well, I'm trying to say that I'm not saying that.
Right.
Wall Street, but it's just I think it's important to be knowledgeable. I think people should.
Yeah, and it becomes tricky because over the years it's become more and more complicated, right? So the average voter has a hard time keeping up with it, right? So, I mean, even look at this diagram, right? I mean, it's just crazy. There's just like lines going everywhere. I mean, there's just so many factors, and even the regulators can't keep up, right? Truth be told, most of them just don't even understand these sorts of finance.
And, moreover, the smartest people don't become regulators.
Exactly.
They go work, at banks, right? Because, I mean, let's just be honest. I mean, a lot of people the majority of people are just motivated by money, right? I mean, that is what it is. That's not a value statement at all. And I mean, here you're making 200,000, whatever it is, and here you're making like 50,000, right? So that also happens. That sort of gets back to your point, intelligence difference.
Do you notice any general reaction?
Max, any thoughts? No.
Well, we promised that, I don't know, so we've been told constantly that our class tends to make people cynical. We're going to try to be more optimistic later on, but it gets back to Fahad's point, right? So, we bring all this not to make necessarily value judgments or, derail the financial sector folks as being evil and corrupt. I mean, that's not the point. At the end of the day, it's just people responding to incentives. And, it's up to you guys as voters to hopefully become more informed about this so you can write to your congressman and say, look, this is something you really care about. Make sure it doesn't happen again. You need to be voting on sort of the right side of these issues, right? So that's the point of this, right? The more you know, sure, it's a little bit disheartening, a little bit disillusioning, but it empowers you to go on and then vote for legislation that fixes the problem in a way that you believe.
And I think at the end of the day, that's the motivation for teaching the class.
Yeah.
At the end of the day, right? So it just sort of all comes back to full circle.